This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We now turn our attention to the last, indeed, of the personal taxes. Some may say, indeed, the final personal tax. There is that old expression that you may be familiar with. You can't take it with you when you go. Yep, you're afraid you can't take your assets with you when you die. Reason being, HMRC. They are there to take their share of the value of those assets when you die in the form of this tax, inheritance tax. Now, again, there is literally no escape from taxation. From the moment that you're born, you become liable to the various personal taxes, though probably to begin with, not too many of them will be applicable to you. But through your lifetime, you'll have income that is chargeable to income tax. Through your lifetime, you may have chargeable disposals of chargeable assets, and you being a chargeable person, you suffer capital gains tax. On your earned income, employment income, or indeed your self-employment income, your trading income, there's national insurance contributions that are chargeable. And as we'll see, when you die, or even before you die, if you really want to pay IHT, you can pay IHT in lifetime indeed, as we'll see. But certainly when you die, this is the main situation, if not indeed the one situation that for the majority of UK taxpayers will be their only experience of chargeability to inheritance tax, or as we'll call it now, IHT from this point on. So for most taxpayers, their only contact with the IHT system is when they die. And then it's a fairly simple exercise of basically preparing like a little balance sheet for the taxpayer on the date of their death, listing out all the assets that they held and taking away any liabilities that were due at the date of death. And that computation that you may well be required to do in answer to an examination question is known as the chargeable estate. We prepare a computation for the chargeable estate. As I say, a simple listing of the assets held by the taxpayer when they died, less, to begin with, any liabilities that may be due by the taxpayer. You owed maybe the taxman again there, maybe a credit card bill, any loans outstanding. All of those would serve to reduce the value of your so-called chargeable estate. Now, just because you die with an estate, you own assets, it doesn't mean to say that you will necessarily pay any inheritance tax. Because to begin with, there's a very, very pleasant rate of taxation. The nil rate band. There's a nil rate tax. Currently, and it's been this way for quite a long time, £325,000. But as soon as the estate goes over that level of £325,000 worth of chargeable estate, you move dramatically from a nil rate band to the excess over that nil rate band being taxed at 40%. This makes it a very serious tax charge. It means that for taxpayers who have estates worth over £325,000, and then depending on where they intend to bequeath where they intend to leave the assets held within their estate, to think that on that excess over the nil rate band, 40% of it may end up in the hands of HMRC, that's a pretty daunting prospect. Now, no matter how much from time to time we may dislike our children, I'm presuming here that we probably still do like them slightly more, on a good day anyway, than HMRC. So clearly this is something that needs to be planned for. Certainly when you come to P6 with just a little bit of involvement now at F6, we start to look at ways by which in lifetime you may seek to mitigate what would otherwise be your eventual IHT liability when you die, as the excess over the available nil rate band at that date is going to be taxed at 40%. Now then, we've mentioned there that for most taxpayers, their only contact is when they die. Let's calculate the chargeable estate. If it's less than £325,000, no inheritance tax is payable in relation to their estate. Anything over 325 will be taxed at 40%. But if it were only the assets that you still actually owned at the point at which you died, at the time of death, if only they were to be taxable, then something called, here's a lovely expression, deathbed gifting, i.e. giving away your assets just prior to when you died, would effectively avoid this tax. If I knew that I'd only got a very little time left upon this earth and I'd got £1 million worth of assets that otherwise would feature within my chargeable estate, that would give a very large figure of IHT to pay, what would I do? I'd give them away now, while I was still able, while I was still alive. Now, that has got to be far too easy a way of avoiding IHT. So what happens, therefore, is that certain lifetime gifts, basically those made within the 7 years of the death of the taxpayer, they will also become chargeable on the death of the taxpayer. What we'll discover, therefore, is that the typical scenario that we may meet is, in an exam question, the taxpayer has died. This is what the taxpayer still owned when they died and what they owed at the date of death. You put that together in calculating the so-called chargeable estate. But in working out how much, if any, of the nil rate band is still available to go against that chargeable estate, we then have to look at the lifetime transfers, the gifts made in lifetime during the 7 years prior to the date of death, and they too will then become chargeable. And as we'll discover in these notes as we work through in the next few minutes, that the earliest of those transfers within the 7 years before death would be the first to take advantage of any nil rate band. In terms of lifetime transfers, we'll discover that most transfers that you make in lifetime would only become chargeable on death, and only then if you died within 7 years of having made them. But there are also some transfers made in lifetime, those into trusts, that will generate immediate chargeability to IHT, as well as further chargeability on death. So most lifetime gifts made where you give cash or whatever assets to your sons, to your daughters, to your grandchildren, nieces, nephews, there, you'll notice I'm not mentioning the spouse here, your husband or wife, for as we'll discover in a few minutes' time, any such transfers between spouses or civil partners, of course, we recognise having the same tax status as spouses, any such transfers between spouses are exempt for IHT purposes. But otherwise, if we make gifts, say for example most likely to our children, grandchildren in lifetime, then the only time that they would become chargeable to IHT is when you die, and only if you die within 7 years of having made those transfers. If I give away assets now and live for at least 7 years, then those gifts, those lifetime transfers, will not then be chargeable as a result of death. But if the nature of my lifetime gift was into a trust, then there are much more immediate IHT consequences. There will be an immediate chargeability to tax if I make a transfer into a trust. Now we're going to put names on these different types of transfers as we go through these notes, and no need for you to note these expressions now because we'll be coming to them very soon. But we've already mentioned that when you die, we put together a working known as the chargeable estate. That will be a list of assets held at the date of death and a deduction in relation to any liabilities due by the taxpayer at the date of death. We must also look at the lifetime transfers, and we must differentiate between those lifetime transfers to individuals that may become chargeable on death and those transfers into trusts that were both immediately chargeable when made and also then become chargeable on death, but only if you die within 7 years of having made them. Now we're going to have names on those different types of transfers. The transfers into trusts will be known as CLTs, chargeable lifetime transfers, CLTs there. And any other type of transfer other than an exempt transfer, for example to your spouse, those type of transfers, they have lovely names. They will be known as PETs, or PETs as we know them. We're all pet lovers, I'm sure. That's obviously an acronym, but PETs there for potentially exempt transfers. Why the name potentially exempt transfer? Well, as I've just said, if I make a gift now and live for at least 7 years, which I seriously anticipate and hope I'll do, but as long as I live for 7 years following the gift, what was potentially exempt when made would become exempt. But having made this potentially exempt transfer, if I don't survive for the required 7 years, then what was potentially exempt when made will become chargeable on death. So two main types of lifetime transfer that are going to have or may have inheritance tax consequences: CLTs, chargeable lifetime transfers, transfers into trusts, chargeable when made at, as we'll discover, a lifetime rate of tax, and also then there may be an additional charge when you die. Otherwise, transfers made that are not CLTs and which are not exempt transfers are PETs, potentially exempt transfers. No tax when made. If you live for more than 7 years, there will never be any tax, but if, as will be the case in an exam question, you die within 7 years of having made the transfer, then there will be chargeability when you die. Now then, in relation to these gifts, we need values. We need to have a value on a gift when made, either in lifetime or if as part of your chargeable estate at death. And that demands that we can calculate for each such transfer what we call the transfer of value. Now you will remember that back when we looked at CGT, for CGT to arise in relation to a lifetime gift, there has to be a chargeable disposal of a chargeable asset by a chargeable person. For IHT to arise either on death or in lifetime, there has to be a transfer of value. Now then, let's get to grips with what we mean by this. When we die, the transfer of value will be a very simple calculation. The transfer of value will simply be the market value of the asset when you die that is now being gifted to the beneficiaries. Now you may think that market value would always be the transfer of value, even on a lifetime transfer, but we'll discover that the meaning of transfer of value, though it normally equates to the market value of the asset when gifted, may be other than that in just one or two more interesting situations, maybe one or two of which may be eminently examinable in your exam. Right, let's have a look what we say then about IHT. Here's an expression we'll come to know and love. It is a cumulative donor-based tax. When you make a gift, clearly there is a donor and a donee. We witness that in capital gains tax there. This amount of tax, it's a cumulative donor-based tax. So the amount of tax that is payable in relation to any transfer is nothing to do with the donee, the person benefiting from this gift. It's everything to do with the donor. And the amount of tax is calculated on a cumulative basis. Which specific gift in lifetime you happen to have been the beneficiary of will determine how much tax is chargeable in relation to that transfer. So the amount of tax is based on the donor's personal circumstances, though as we will discover, it may very well end up, and it usually does, as being the beneficiary who suffers the cost of that tax. But the amount of tax has got nothing to do with the donee. The amount of tax payable is everything to do with the donor. And as we'll discover, we will work these tax figures out on a cumulative basis. For it to arise, for IHT to arise, an individual must make a transfer of value. Now, this is the term that we're seeking to define here. Clearly, it's a gift. Now, it's computed as the loss to the estate of the donee. It's therefore calculated as the difference in the estate value before and after the gift of the asset. It is the difference between what the taxpayer had before the transfer and what the taxpayer had after the transfer. The amount of tax that may be payable on a transfer of value is based, as we said, on the cumulative amount of transfers made by the donor, cumulative amount of transfers made by the donor over, as we'll see, a 7-year period. We've already stated that in relation to the main point of chargeability to IHP for the majority of UK taxpayers, it's when they die. But we only then wind the clock back to look at transfers made within the 7 years before death, for only they will be taxable as a result of death. But as we mentioned, you may make a transfer into a trust, a transfer made in lifetime, that is immediately chargeable there. So again, it will be based on a cumulative basis, looking at the amount of transfers made by the donor, and we will work on a 7-year rolling cycle. Now, more of that as we go through our examples. Now, as we've already said, for most assets, the transfer of value will simply be the market value. And we give examples of that here. Gifting a property worth £250,000 to your daughter. Before the transfer, I owned the property worth £250,000. After the transfer, I don't own the property. So the difference, therefore, this transfer of value, this difference between what I had before and what I had after the transfer, is very obviously £250,000, the open market value of the asset. Or I give away cash of £100,000 to my son. I had the cash before the transfer, I don't have it after the transfer. So very obviously, there the market value of what you are gifting is the transfer of value. But as we said, for some assets, most notably the most likely in our exam, shares in unquoted companies, the transfer of value may be considerably higher than the market value of the asset being gifted. Now let's look at that in relation, we said, to shares in an unquoted company. Now let's set the scene here before we deal with illustration 1. Now, in relation to shares in unquoted companies, if you had the opportunity of acquiring a 1% interest in an unquoted company, where mostly unquoted companies are held in terms of shares by just a few taxpayers, again a group of friends maybe who got together to form a business, or families indeed. Now, would you be interested in buying in to a 1% interest in such a company? Basically, no. You can do nothing with your 1%. And because you can do nothing with it, anybody who would acquire it from you can do nothing with it. Again, the other members of the family, their own 99% of the shares, then you have no ability to influence that particular company, so it has a very low value. But contrast that with, would you be interested in acquiring a 51% interest in a company? Well, yeah, because then you have control. So my point, do you think that the value of a 51% interest in an unquoted company equals 51 times the value of a 1% interest? Remembering that 1% will be worth very little. 51 times very little is still very little. So no, what we realize and what we will see in our examples as in real life is that the value, the price per share of shares in unquoted companies will increase along with the level of shareholding. The price per share on a 51% interest is much, much, much greater than the price per share on a 1% interest. So with that backdrop, let's look at illustration 1, where we're told that A owns 60% of the shares in A Limited. A Limited has 100,000 £1 ordinary shares in issue. So we now know A owns 60% of 100,000 shares, A owns 60,000 shares. And we've been told that share valuations have been agreed as follows. This is agreed with HMRC. They even have their own share valuation division here. So we've got these agreed valuations such as would be provided to you within your examination question. What we've now got to do is to compute the transfer of value if A were to die, leaving his shares to his daughter. Now that will be the easier of the circumstances to deal with, or far more interestingly, where the transfer of value principle will be seen to be the situation where it can be far greater than merely the market value of what is being gifted. Alternative we'll deal with if you were to make a lifetime gift of 20,000 shares to his daughter. Right, let's have a look at our answer to this. The first one. If A died owning 60,000 shares, what did I have before the death? 60,000 shares. After? Nothing. How do we value 60,000 shares? It's a 60% shareholding. So looking at our list, 60% shareholding there, we would value those shares at £25 per share. 60,000 at £25 would be 1.5 million. A very easy calculation at that point of death. But if you're going to get a test exercise on this in your exam question, you'll be dealing with the calculation of the transfer of value where a lifetime gift is made of some but not all of those shares. Like here, if he were to give 20,000 shares in lifetime, the transfer of value would now need to be based on the loss to the estate of the donor. It would not be based on the value of a 20% interest. What is the value of what is being gifted? I'm giving away, or A rather is giving away here, 20,000 shares. That is a 20% interest in the company. How do we value a 20% interest? At £10 per share. Now, if you can remember your capital gains tax, if you were to give shares away in lifetime, then a gift is a chargeable disposal, shares are chargeable assets, and a gain would be computed based on open market value. So for CGT purposes, while you were alive, the implications of that gift are immediate. There would be a capital gain to compute based on the open market value of the asset, £10 per share. And this is where, interestingly, we can now see a link between our two taxes. That in fact, whereas CGT was immediately chargeable, take the open market value, 20,000 shares at £10 a share, that would be what market value of 200,000. Deduct from it the cost of those shares to the taxpayer, and you would have the gain. That gain is what would have arisen in lifetime, albeit, and I do hope you can recollect this, that if you gave away shares in an unquoted trading company, then for CGT purposes there is actually no need for an immediate gain to be chargeable, that in fact gift relief is available if jointly claimed by donor and donee. So you've seen lifetime gifts already in the context of CGT. Well, important now to understand that when that gift is made, there is a relevance for inheritance tax as well. The type of gift being made, we'll see the specific note very soon, but I've already mentioned to you, if you give away assets in lifetime to other taxpayers, other than exempt transfers, basically your spouse, and other than transfers into trust, those being chargeable lifetime transfers, they are known as potentially exempt transfers. So there'd be no immediate IHT chargeability. But it would become chargeable if you died within, I hope you're saying now, 7 years. And if that were to happen here in the case of A and his or her gift to the daughter there, his shares to his daughter, so If he died within 7 years of making this gift of the shares to his daughter, then we'd have to calculate the potentially exempt transfer, for which we'd need to know the transfer of value. Now, how would we compute that transfer of value? We would not look, as we did for CGT, at merely the market value of the asset being gifted, i.e. £10 per share on 20,000 shares would be 200,000. But instead, it would be computed as the difference between, remember what it was? What he had before the transfer and what he had after. The value of his estate before and after the transfer. So we simply make that comparison. Here, in relation to the shares being gifted, how many shares did he own before the transfer and what value did they have? How many shares did he have after the transfer and what value would they have? Before the transfer, 60,000 shares, which we know to be a 60% interest in the company, and to have a price of £25 per share. There it is. After the transfer, well, 60,000, he gives away 20,000, he owns 40,000 shares. Well, that will represent a 40% interest. Now, whereas a 60% interest was valued at £25 a share, a 40% interest is valued there at £15 per share. So let's work out the difference between what A had before the transfer and what A had after the transfer. Before the transfer, 60,000 shares at £25. We've already done that calculation, 1.5 million. After the transfer, 40,000 shares, now being a 40% holding, is valued at only £15 a share, 600,000. Look at the transfer of value we've computed, 900,000. So for IHT purposes, if A were to die within 7 years of having made this gift to his daughter, then there would be a transfer of value amounting to £900,000. Now, that calculation that we've just done there of the transfer of value in this scenario could be worth 4 or 5 marks in an examination question. Now, it's a very easy calculation to do once you've learnt the basic principle. Don't look at the market value of what is being gifted. That is the CGT rule. For IHT purposes, look at the loss to the estate of the donor, the difference in the value between what he had before the transfer and what he had after the transfer. That is the transfer of value, and if our donor sadly does die within the next 7 years, it is that that would become the basis of the chargeability to inheritance tax when A dies. A transfer of value will arise by the gift of an asset, as we have said, either in lifetime, like the gift of the shares there to the daughter, and or on death. For most taxpayers, as we've stated in our introduction, their only transfers of value will arise as a result of their death. That will simply mean what was the market value of the assets held when the taxpayer died, and that will go into their chargeable estate. I'd like you to just look again and maybe replay through what we've just been discussing. The calculations that we've just seen in relation to the transfer of value. As I say, that basic calculation of before and after, plus a few other things to go into then calculating the chargeable transfer. This is the start of the process. This gives you the transfer of value. Now that could be worth 4 or 5 marks. With a chargeable transfer, it could be worth 6 or 7 marks. So just go back through that, make sure you're happy with it, and also think about, you'll never have to deal with any direct interaction between the two taxes, but the fact that a gift made in lifetime may have been immediately chargeable to CGT, and a capital gain may have arisen, such as we've seen here, based on the market value of the asset being gifted. And then, to make matters worse, if the donor dies within 7 years, then the transfer of value arising may become chargeable to IHT. And once you've used up your nil rate band at a rate of 40%. This is a very serious issue. So just pause for a moment, go back, make sure you're happy with those calculations before we continue.
So, on the death of the taxpayer, we will be required, therefore, to prepare the chargeable estate at death. The death estate here will contain, it will list out within it all of the assets held by the taxpayer as at their date of death, and like a little balance sheet for the individual at that date, it will also be reduced by any liabilities, any debts due by that taxpayer at that date of death. So it's essentially a listing exercise. All of the assets have to be given to you so far as the exam question is concerned, but only on one or two of them will you have an issue pertaining to the value. Now, we've already seen just previously the transfer of value principle. Now, that one is usually tested out and is a more interesting calculation for a lifetime gift, and most notably, as we've seen, shares in unquoted companies are usually the particular assets concerned. The point is that on death, what you had before is whatever was the value of the asset then, and what you have afterwards is nothing because you're dead. So in which case the transfer of value principle is a very much easier one to deal with than in the previous example on a lifetime transfer of value, where we had to establish what that taxpayer's estate was both before and after the transfer. But other than that transfer of value principle, particularly relevant, as we said, to unquoted shares, there's only a couple of other valuation issues that we need to worry about at this level in our exams at F6. Firstly, a property, probably the most likely asset any taxpayer will still own as at the date of their death. Now, if a property held in the estate is mortgaged, again, we might be fortunate enough to have paid off all of our mortgage, but in an exam question, probably not going to be the case. So if a property held in the estate is mortgaged, then the mortgage would serve to reduce the property value, because the mortgage has to be paid off out of the value of that estate prior to, of course, any remaining net value going to the beneficiary or beneficiaries. Now, that's an obvious one. Of course, you've got to reduce the value of the property by the mortgage. But now we have to be a little bit more careful, because if it is a repayment or interest-only mortgage, then that is exactly what we do. If we've got a property valued at the date of death at £300,000, and we have a mortgage on that of £100,000 that is said to be either a repayment or interest-only mortgage, into your death estate, you show the property worth 300 less the mortgage 100, leaving therefore a net value within that estate at death of £200,000. But then we have to watch out for the exception to that. Again, watch out for that word, an endowment mortgage. Endowment mortgages are not deducted. As a result of the death of the taxpayer, they will be repaid on death by the life assurance part of that mortgage. If you have such a thing, and don't worry about the name, it is just a name to recognise. Again, you have to appreciate the every detail about a particular financial instrument here. But all you've got to do is to recognise, if they tell you it's an endowment mortgage, we do not deduct the endowment mortgage from the value of the property. As I say, the basic reason being, every month when you pay your mortgage, what you are paying is partly a premium on a life policy, such that if you were to die within the period, the terms of that endowment mortgage, then automatically there is enough there in the life policy to pay off that mortgage. So if as a result of your death that is triggered, the mortgage is paid off. Therefore, it's not a deduction from the value of the property. So we deduct interest only or repayment mortgages. We do not deduct endowment. If you get an endowment mortgage, therefore, other than on an objective testing question where you don't have to give explanations, on a written question, then you make sure that the point is that because it's an endowment mortgage, it is not deducted from the value of the property. The estate should also include in it the proceeds of any separate life assurance policy. Note, the proceeds. Now that might seem very obvious, but two figures will be provided to you on any exam question, and that will be both the proceeds, which is the figure that you want, proceeds that then realised on the death of the taxpayer, re this life assurance policy. It is that you use rather than what will be a separately given figure, and that would be the market value of the policy at the date of death. That is not the figure we use, we pick up the proceeds. So, very, very simple exercises therefore, mostly just listing out the values of the assets given to you in the question, but just a couple of exercises that may need to be done, using the transfer of value system so far as unquoted shares are concerned, taking out or not taking out the amount of a mortgage in relation to a property, and then picking up the proceeds of a life assurance policy rather than the market value at the date of death. What you'd also have to do, as we said, it was like a balance sheet. Therefore, the value of that estate will have to be reduced by any legally enforceable debts due at that date. So, for example, credit card bills there. That was a liability. It doesn't get wiped clean just because you happen to have died. That will need to be paid out of the deceased's estate. What we're also able to do is to take out funeral expenses, or to be precise, reasonable funeral expenses. Well, you'll see nothing other than that in terms of your exam question. And then any exempt bequests, which we come to separately here, and we'll list them out in a moment's time. But one point about that statement, legally enforceable debts. Another common issue that what they tell you within an exam question is that we had these credit card bills of £2,000 that were outstanding at the date of death. There were funeral expenses of £5,000 that were incurred so far as the deceased was concerned, both of which are deductible. But you're also then told, oh, before he died, he had promised to pay a hospital bill, a legal bill, whatever bill of a friend or neighbour or relative. Now that's fine. And if you want to take some of the value of the estate out and give it to that person to make that payment, then fine. But that is not a debt. That is not a legally enforceable debt. The fact that the individual said to the other person, oh yeah, I'll pay that for you. Sorry, not legally enforceable, and therefore you do not get to deduct in determining the value of the chargeable estate. But we do get to deduct exempt bequests, which are very simple so far as our syllabus is concerned, because that is simply what you have given to, or what you will be giving to, a spouse. And remember, whenever we talk about a spouse, in tax we also mean civil partner there. Okay, so we list out the assets given to us so far as the chargeable estate are concerned, using the valuation rules that we've just seen, and also making sure that we deduct the appropriate mortgage from the value of a property. Remember there, not the value of an endowment mortgage. That one is not deducted. But we also deduct any legally enforceable debts plus reasonable funeral expenses there. Take out any exempt bequests, and then we have our chargeable estate. Now, once you've got the value of the chargeable estate, we then need to know whether or not it will all be taxed at 0, nil rate, or goes up into, of course, as it will in our exam question, up into the 40% band. So the available nil rate band is deducted from the value of the chargeable estate, i.e. all of that part of the chargeable estate is taxed at nil. The current nil rate band, as we know, and it's been this way for a long time, is £325,000. The available nil rate band is £325,000 reduced by any lifetime chargeable transfers that were made by the deceased, but remember, only those made within the 7 years before the date of death. So, get your chargeable estate at death. Work out then what is the available nil rate band. If you have not made any lifetime transfers, or at least any in the 7 years before death, then the full £325,000 nil rate band is available to you, and only the excess is taxed at 40%. If, as we'll see soon, you had made lifetime transfers of, say, £225,000 in the 7 years before death, then that amount of your 325,000 nil rate band would have been used against those lifetime transfers, meaning there'd be no tax to pay thereon. But that would mean if you've used 225 out of 325, only 100,000 of remaining available nil rate band would exist to then go against your chargeable estate at death. The balance again then taxed at 40%. The IHT liability has to be paid by, sometimes referred to as written there, the personal representatives, or you might see written the executors. Again, we can use those terms synonymously. Personal representatives or executors. And they will have to make the payment of the inheritance tax out of the value of the estate. And until they've done that, they do not get what they are called letters of probate. Probate will not be granted. Now, the point about the granting of probate is until that has been granted, the estate will not be available to be distributed to the beneficiaries. So the IHT liability paid by the personal representatives before they get letters of probate, allowing the estate to be distributed. As we'll discover, it will be due, this tax, 6 months after the end of the month in which the taxpayer died, and you would normally expect that we would wait until the last moment before we part with the cash and pay any tax. Here we may well discover that we pay that tax much sooner, because until and unless that tax has been paid over to HMRC, probate is not granted, and the beneficiaries will be kept waiting for the value of the deceased estate to go to them. So there is an encouragement there for those that remain behind, the personal representatives, to clear and agree the estate and the amount of tax payable as a result of the death of the taxpayer with HMRC, get probate granted, that is after the tax has been paid, and then the remaining net asset value may be distributed according to the terms of the will. Now, of course, the tax to be paid on the estate comes out of the value of the estate. Not going to be the poor old personal representatives dipping into their own pockets that have to pay that tax. Of course not. That money is going to come out of the estate at death. So the IHT that is payable is suffered by the beneficiaries. The more tax that has to be paid out of the estate, the less value that remains within it to be distributed to the beneficiaries. So although the tax is paid by the personal representatives, it is suffered by the beneficiaries. And then we have a lovely name for the beneficiary, who is usually the one beneficiary that will actually suffer the full cost of the tax on the death estate. And that is someone called, there you go, there's a name and a half, the residuary legatee. The residuary legatee. Who is this person? The person receiving the balance of the estate after any specific legacies have been paid out. So if in your will you decree that you want A to have £30,000, V to have £20,000, F to have £10,000, and C to have your prized possession, your set of Aston Villa football programmes worth clearly tens of thousands of pounds, then if you have made specific gifts of those assets, the 30,000, the 20,000, the 10,000, the football programmes there, all of those will go without any tax charge upon them directly to the specific beneficiaries. And then the rest of the estate goes to the residuary legatee. Let's call him or her X. And what it means is, after the specific legacies have been paid out, the rest of the estate, after any tax has been paid thereon, is what goes to the residuary legatee. So it is they, the residuary legatee or legatees, that bear the cost of that tax. It's paid by the personal representatives and it's borne by the residuary legatee. Now, it may be that there isn't a residual legatee. You don't write your will in that way, where you want these amounts and assets to go to specific beneficiaries and the rest of the estate to go to X. Instead, you might say, I want my estate divided equally between these four people, A, V, F and C, in which case, therefore, they all suffer 1/4, 1 share, equal share of the total tax charge. But again, if your will is written that way, that way when I mean the first method, the specific beneficiaries and then the balance of the estate to the residual legatee, it is that person that suffers, who bears the cost of the tax on the entire estate. Right, let's just finish this session therefore with a nice simple illustration, illustration 2. We have our heroine here, bless her, departed, the humorously entitled and named departed, a spinster. That simply is a good old-fashioned word for a lady that was never married. Now, I've simply put that in, meaning that there is no spouse, nor was there ever a spouse. Had there been a spouse, or if there was a spouse, that brings in other possibilities of what might need to be done, not the least that any bequest to the surviving spouse would, of course, be an exempt transfer. So I'm excluding that from this particular problem. But D here died on the 1st of February 17, leaving an estate valued at 0.75. So that listing exercise has already been done for you here. The valuation exercise, the deductibility of mortgage or other liabilities has been dealt with. And we've got a chargeable estate valued at 0.75 million. She'd made no chargeable transfers of value in her lifetime, let alone made within the 7 years before death. What does that mean? It means if there were no lifetime transfers within the 7 years before the date of death, then none of the nil rate band will have been used on such lifetime transfers, so it is all available to go against the chargeable estate at death. She's now bequeathed her estate, left her estate to be split equally between her nieces and nephews, so no residual legatee. Each of the nieces and nephews will bear their own share of the total tax due on the estate at death. So a very simple exercise. Who are we dealing with? Young D here. We would be, of course, in an exam question, having to list out the content of the chargeable estate at death, and we state the date of death there. Chargeable estate at death, February the 1st, 2017. Net assets, £750,000. Now that was the value of the chargeable estate. There's no exempt legacies there to a spouse or civil partner to be deducted from that. So the chargeable estate is also £750,000. There were no lifetime transfers in the 7 years before death, hence the first £325,000 will be at nil. That will still leave out of the 750 a balance of 425 to bring us back to that total there of 750. We're now out of the nil rate and up into the 40% band, and that therefore will give us a figure of £170,000. Remember who has to pay it? It's the personal representatives. When do they have to pay it? Within 6 months of the end of the month in which the taxpayer died. That was February 2017. Therefore, the £170,000 tax there will have to be paid by the 31st of August 17, 6 months after the end of the month in which the taxpayer died. The tax, as we said, will come out of the estate and hence is borne by the beneficiaries, the nieces and nephews. They are, as it were, the residual legatees. There is no specific residual legatee. Again, where you have got these individuals with specific legacies, no residue to a residual legatee. They will all bear their own share of that tax charge. So there we go, our first and very simple IHT computation for poor young D here, who has died on the 1st of February 17. Now, what of course will happen in terms of any exam question is there will have been lifetime transfers, and some, if not all of them, will have occurred within the 7 years before the date of death, and thus impact on the use of the nil rate band, and therefore on how much tax on this chargeable estate of £750,000 may indeed then be payable. But that and all that goes with it awaits us in our next lecture together.